Maverick traders, welcome out to your currency midweek for October 19th. Corey here with you. As always, just a quick reminder, let's make sure that we follow our trading plan and let's get to it. So, unfortunately, I kind of feel like we're a little bit of a broken record because a lot of these things are just kind of been in place for a while and not changing a whole lot. So, let's talk about it. First and foremost, the stock market's in a bear market. It's pretty much been that way for most of 2022. Now, that doesn't mean that stocks just go down every single day, but it's kind of been primarily a risk-off environment. We've recently rallied. It's the best rally we've seen here in the past few weeks, where we're above the 20-period moving average. You really can't say that for the past month or two. So a little bit more meat on this rally, but again, it's going to be a little bit of a back and forth in my view here, a little bit of a choppy environment. We talked about how the US dollar had reached an exhaustion level. So if you're looking for correlations, interest rates have gone up and they're heavily correlated to the US dollar going up. Those two things have been in place. And the reason that rates have been going up, again, the bond market's had a terrible year. Bond prices go down, rates go up, Fed raising rates, et cetera, et cetera. We won't rehash all of those things, but basically kind of this risk-off scenario. Well, the US dollar hit an exhaustion high a few weeks ago that we highlighted, and our best guess was that it would move into more of a symmetrical triangle. And I'll be darned if that's not basically what's kind of happening here. So we're in this consolidative mode. Now look at the stock market, and it's very volatile, but it too is kind of in this weird consolidative, more volatile certainly than the FX markets of late, but still, well, I guess not every currency, but more volatile than the US dollar in terms of its consolidation, but still a similar pattern. Inflation is a concern worldwide. Central banks, so the Bank of England kind of pivoted a couple of weeks ago, but interestingly enough, they backed off of that pivot pretty quickly. They stepped in with a bond buying program and then quickly stepped out of the market, which was kind of a smart move. I sometimes will rip central banks. I'll call them out if I think they do something good or bad. Well, I think the Bank of England, what they did sort of made sense because the markets had become unhinged and there were margin calls and things happening where these trading funds, basically you have endowments, you have pension funds, and they had leveraged up on what they call gilts, which is basically bonds over in the UK. And because of that leverage, it was kind of a domino effect that were toppling over. And they were getting margin calls and forced liquidations, which was pushing the bond market lower and lower. So the Bank of England stepped in and said, hey, we're going to do a big buying program. Well, that does two things. Number one, it stops the toppling of the dominoes. It puts a floor a little bit where they're a big buyer. And sure enough, there was a little bounce, and that's all they needed was enough of a bounce to kind of relieve some of that temporary stress so that day after day, see, markets can become unhinged for a few days and some really weird and wacky things can happen. And that's basically what they did is they said, okay, let's stabilize the market for a few days, let the market work through the supply demand, and then we'll back away. I think it was the right call. That's kind of where central banks should be. They should be basically kind of involved in the markets only when they must be. This whole idea that they can just go in and manipulate the markets and drive asset prices and print money and there's no consequences, that's all ridiculous. That's a ridiculous concept. Of course it matters. Of course the quantity of currency, the amount of debt, all these things, of course they matter. They always have, they always will. But if they would just kind of like 2008, you could argue they fueled the global financial crisis, and I really wouldn't argue that point. But they did some good things, at least in the midst of the crisis, where they came in and they backstopped it a bit. And that's where they should be, is only when required, not in there day after day. The idea that the Fed was still initiating a huge bond buying program with rates at zero is just ridiculous. Why would they continue for years, by the way? Why were they continuing with a money printing bond buying program when rates, for all intents and purposes, around the globe were already at zero? It made no sense, and now we pay the price for it. These inflation rates are still unlikely to come down dramatically. I touched on this last week. The problem is that the way that CPI is calculated, there's a lot of emphasis on rents, owner equivalency rents, what you can rent your house out for, and so on. 30% of CPI is that, and that comes down slowly. You don't cut rent. I've got renters. I'm not out there cutting their rent and saying, hey, pay less. It would really take a lot to get that market to reverse. Now, it might stabilize, it might not go up, but you're not going to see it come down dramatically, and it's a slow moving thing. When rates are going up, there's a very good likelihood that people are going to have to charge more. If you think about somebody buying a rental property right now, their house payment is higher because they have to pay a higher interest rate for the money borrowed. They're going to have to charge more for rent, not less. So those things are not going to reverse overnight or in a short period of time. And you can see inflation is not just a US story. Check this out. Quarter over quarter CPI in in New Zealand at 2.2 versus 1.5. That's 0.7% worse than expected from that standpoint. Higher inflation. That annualizes at about 8.8% on an annualized basis. And then in Canada, they have a year over year CPI 10.1% versus the 10 expected. A little worse than expected from that standpoint, a little bit hotter inflation, but still you're talking about 10% annualized. So in New Zealand, it's 8.8% annualized. In Canada, it's 10.1. Here in the US, we're in the 9 range. Those are high inflation rates. Again, usually central bank targets are more around 2%. So it's certainly it's just gotten away from them. There's no other way to put it. Now, as we look at this week, you can see that stocks have actually bounced. Commodities, crypto still struggling. Little bit of a, difference there where gold is still in a downtrend. Oil is kind of the exception. Energy continues to act better than most other things, but kind of a rough week for commodities, but pretty good for stocks. So here's the bounce that we've been in. Now, again, I think this is a consolidative pattern, that it's sloppy, but I still think you're basically just staying within this range. And it's kind of an inverse cup and handle that we've talked about. It's not really conducive to a ton of upside unless we can really start to go here in the near term. The market needs more of a rally immediately within the next couple of days to really push it up and through this level. I think there could be pile-on buying if you could see a big upward swing here, what they would call a continuation candle. So here was the big reversal candle. We really haven't seen a good burst of buying in terms of a continuation, and those are usually kind of what happens. Look at the reversal here and then the big continuation, and you can see how we rallied for a few weeks. You had a reversal here and you get some bigger continuation, and we get up for a couple more weeks. So if you want to see this rally for a couple more weeks, we really got to see one of those continuation candles, a nice bullish candle here in the very near future. On the flip side of that, if we see a big red candle, you're probably going through the lows in a hurry, quite honestly. So we've been consolidating for the past couple of weeks. Yeah, volatilely, but basically unchanged for the past couple of weeks. The Kiwi bouncing back. Japanese yen continues to be on a death spiral, essentially. And, it's kind of a risk-on start of the week. The riskier things going up, the defensive things going down. That's kind of what's been in place, but most things, again, kind of choppy, kind of sideways here for the shorter term. I don't know what to say about crypto. It's a mess. It continues to go down. Let's not even waste our time with it for now. So let's take a look here. The only thing that's really kind of changed is on this risk off environment, or on risk on, pardon me, we've kind of improved the situation in the short term. We're above the 20 MA. That's really the first time we've been above that 20 MA. You can see here for the last couple of months. You'd really kind of have to go back to August being the last time we were trending above it. So is this a turning point? I mean, it's questionable. Certainly has a little bit more strength. I'm gonna stay a little bit optimistic that the market can bounce a bit further and we can get another week or so out of it, but it's it's far from a sure bet. It's somewhat questionable whether that can continue. International stocks, same thing. I mean, we're really unchanged for the past couple of weeks. Yes, volatile, but we've been in a consolidative mode. Um, as you look at crypto, that's as tight a consolidation as you'll ever see in this market. It's eventually going to break. You can see a kind of a false breakdown there where it acted like it was going to break for the day and then they scooped in and bought it. I wonder if that was a little bit of kind of a temporary break that was a little shakeout, fake out, and then we get the real one here coming in the not too distant future. But for now, it's hard to trade crypto. I mean, it's just you'd kind of have to err on the side of betting bearish, expecting more bearishness. The rest of this week, we get Australian employment data. You can see there's some numbers out of China, GDP and retail sales. Philly Fed here in the US, and some retail sales out of the UK and Canada on Friday. But we're a little bit in, I'm going to call it the calm before the storm. That's kind of where we're at. We've got a Fed meeting coming up. Um, we've got, well, within the next couple of weeks, not only do we have a Fed meeting, we also have large cap tech, which is a big stock market mover. You've got Apple, Amazon, Google, Microsoft, all of those big companies reporting next week. So I think this is, again, just a bit of a calm before the storm, a little bit of choppy behavior, and then we'll see. That's where the markets theoretically could really kind of take off. I wanted to look at a few of these charts. It's a little bit, questionable kind of what we're going to do from here. So here's the Kiwi, and I'm just on the daily chart time frame, really looking at a big picture chart here. You can see where it broke down and really spiraled to the downside from there. We've recently been basing, and it's trying to break out to the upside. Normally when you're going counter trend, so if you said, what's the trend here? Well, this isn't a bear market, right? This is a bearish trend. So I don't really like playing upside breakouts. I'd play downside breakdowns, like if you wanted to short here, expecting this was breaking down. Okay, great, because you're working with the dominant trend. I wouldn't trust this breakout, but let me say that what it might be doing is stair-stepping its way, at least in a sort of ABC 1, 2, 3 type of pattern, corrective type of phase. So I am going to look at the next dip. The Kiwi will dip in the not too distant future for a couple of days, and I'm going to look at it and say, okay, is this the type of pullback that's going to establish a higher low here? The type that I want to buy? Or does it not have it and it's just going to go here? If I think that we're establishing a little bit of a higher low, I can buy the next dip. The Aussie really struggling, not even bouncing with the CAD or with the Kiwi recently. But, whoops, let me try and get that straight. Why is that not triggering? Hold on one second. If I hold down this key, it's supposed to draw straight. There you go. So that's kind of the breakdown zone. Again, not as strong as the Kiwi recently, but I would put it in the same category of kind of hitting a bottom, bouncing up. I want to see if it pulls back for a day or two, if it can kind of establish a higher low that might be worth buying. Now, what will that be dictated upon? I think I would like to see the stock market have one of those continuation days. If it has a bullish continuation day within the next 2 days, then I'm going to be buying these pairs in that scenario. If the market breaks hard lower, I don't think I'll trust it. I think I'm just going to use that as somewhat confirmation. So if the S&P, has a big expanded range bearish candle instead of bullish, we'll probably head back towards the lows. I'm going to assume, although it's not perfectly correlated by any means, I'm going to assume these are not going to have what it takes. And, frankly, the Aussie would be more of a short in that mode. The CAD, it's been consolidating. Out of the three, this is really the best chart, obviously. Kind of an ascending triangle, still in an uptrend versus other currencies. And I think this would be the more obvious play just in terms of relative strength if we want to stick with the trend scenario. So these are what I would call bounce back, and they can have a swift, short-term, kind of short covering rally. They actually give you a little bit more bang for your buck. CAD, it's still in this consolidation, but I think we could easily continue to work our way higher here. I mean, even today with CPI running a little bit hotter than expected, it's still doing pretty well, bouncing off the lows and so on. So CAD looks pretty strong. Pound has been rallying. I'm not as inclined to trade this one. I worry. Let's turn to a weekly chart, and it'll give you a kind of a big picture view that if you look at this price pattern, in fact, I'm going to do this because I already have it here. If you look at, well, if you think about it from the standpoint of charts and trends and so on, let's add the Bollinger Bands on here with the 20 and 2. And here's what I'm kind of concerned about. This is, again, on a really long-term weekly chart time frame. But see how we've rallied up. We're still below that 50-week moving average, which is exactly where we stalled, and up near the upper band. This is kind of, I get used to looking at this price pattern of typically when you get to the upper band area and you're still below the 50-week moving average, that's more of a place to sell than to buy. So just not really trusting that I want to be involved in the British pound here on the long side. I'm not sure that I trust that this is just going to continue to run higher. Euro. The euro is interesting where it's just, I mean, it was left for dead, obviously. It was trading well below parity versus the US dollar. It actually has made this nice round trip versus other currencies. Look at how clean that circle is right there, that half circle, right? That's the cup formation. If you get a little sell-off, this is actually my favorite chart setup in FX land, and I want to buy where I think the handle is. So if we're using these baskets, the euro prices out, I'm going to call the top of the cup 128. Again, remember, this isn't a perfect science. This is kind of the general area. You can look at the lows down there. It's close to 121. It's a little bit above that. I mean, if we put our line on it, 121.05 or whatever. But again, it's not really an exact science. I'm just going to round it to 121. So the difference there is obviously you could add the zeros so you get it in more in pip language, right? But you're basically 128 minus 121. That's 700 pips, 700 points difference basically, right? 0.0700 difference. Now, What is 30% of that? Because that's usually the size of the handle. And 30% of that is 210, or that number. And the reason that I want to know that is, well, that kind of gives me an idea for where the handle is going to be located. It's basically going to be about 210 pips below where it's hitting right here at 128, right? If this is the size of the cup, the handle will usually be about 30% of the size of the cup, which is about 210. So if we take 128 and we subtract 0.0210, that gives us 125.90. So just about right here. And I would even call it 126. Make it easy on yourself. Those 10 pips are not critical. It's basically down to 126. And 126 is where I'm going to be more, very, very interested, more aggressively looking at buying euro pairs. Now, that's going to take a while. First, there's no guarantee it's going to get down towards 126. Second, there's no guarantee that if it gets down to 126, it's going to look perfect. But basically, that's what I would expect. I would expect it backs up. So I do, put a gun to my head. I think I'm more short the euro than long right here for the next couple hundred pips. But it should back off resistance, work its way back to about 126, and that looks like a fantastic opportunity. So I have alerts and things to really be aware of when the euro gets down to around 126. That's where I would want to be more aggressively buying. Swiss franc, symmetrical triangle, okay? Once it breaks out of that, you've got to play right here. You don't. US dollar, I'm going to skip the yen for now. US dollar, similar, kind of in this consolidative mode. I expected a little bit more give back here, but I think, it's kind of in that consolidating pattern. And last but not least, let's go to the yen, which has just been a disaster currency. You're basically back to where you were a couple of months ago. And that was, we talked about how bad it was down here and kind of how it had an exhaustion low. And sure enough, it bounced for a while, but we're right back down to those levels. The yen, I'm not trading the yen a lot right now, which has been a missed opportunity, frankly. Had you been short the yen, but it just didn't give me, the way that I trade, it didn't give me a real clear picture. This was all messy. The moving averages were messy. Was it consolidating up here and going to break higher? Was it going to fail? Well, it failed, right? But it just wasn't real clean. It wasn't real obvious kind of where it was at in terms of context, what phase it was in, anything like that. I just didn't feel like I had a good grasp on it, and still don't. So to me, you're better off trading the yen on your own. I'm going to, not pass a lot of judgment here because I just don't know. I don't know what comes next for the yen. I don't feel like I have a good feel for it. But euro is very interesting. I'd still lean more towards buying risk on and thinking that the stock market pushes a little further to the upside. It's kind of where I'm at on things. Let's take a look. So the question was in regard to the pound charts on the daily. So let me come over to another chart here. This is the daily time frame, and if I just click through a few of the pound currencies, you can see a little bit of a pullback on the daily charts, right? It's in a little bull pullback mode. Here it is against the CAD, a little bit of a pullback. You'd have to give the pound a little bit of credit in terms of, hey, it's had a nice couple of weeks. It was really when the Bank of England stepped in that was the turning point. First it plunged and then it rebounded, and that set the low. So I don't know. I'm kind of, am trading some other outlooks. I'm not trading anything right now, but I'm trading for certain things. I would look to buy the Aussie and Kiwi and CAD here in the near term, I think. Look to buy if I had to do anything with the euro right now, I would short it, but around that 126 level, I'd be more of an aggressive buyer in the euro. Maybe buying the euro against everything. I don't know what I would prefer to trade it against, but pretty much everything, because I think against the basket, euro looks very interesting there at those levels. So it's going to take some time. That would take a few days to get down there. But if it does, that's what I would be looking at. Pound, I'm just not super interested in. I'm going to kind of put it in the same category as the Japanese yen and say, well, I don't know that I have a good opinion that's going to be all that helpful. All right, so on the events, we have a currency recap coming out tonight, and then the currency room this weekend. Looks like the classes are done for this week. Next week, we get into Fibonacci relationships, which will come out on Tuesday. So, as always, we'll be looking for opportunities. We do have some events coming up. We have the Fed meeting not too far away. We've got some other things, but for the rest of this week, should be more technical based, should be more just trading off of opportunities that you see. Thanks again, everyone, for being here. Have a great rest of your week, and we'll see you next time. Goodbye.